Hello and welcome to our mid-year volatility webinar to give some insights and context around the current volatility and how wise investors can manage that in their own minds, understanding what historical patterns are about how to handle volatility and what some of the pitfalls are to avoid. The most important place to start is focusing on what you can control, that space between things that matter and what you can control. You can't control markets, you can't control politics or trade policy or tariffs or the economy, but you can control having a strategy, sticking with it, and avoiding being an emotional investor so that you benefit from the long-term patterns of investing, regardless of what the short-term patterns might be. The main driver of the volatility over the last few months and what might be on the horizon in the future is the current administration in Washington's trade tariff and trade war policy that has raised, increased, and magnified a lot of uncertainty regarding the economic outlook. The overall US economy had been cooling, but had been in a fairly solid place with solid growth levels and controlled inflation after a period of inflation, and trade tariffs tend to slow economies down on both sides, tend not to have a clear winner during or after. In the long run, it tends to be a lose-lose scenario based on analyses of past trade wars and tariff regimes, and tends to have an upward impact on inflation and increases uncertainty significantly. And the current environment with the administration in Washington, with the off again, on again, changing new tariffs, may be a negotiation tactic to try to set the other parties into a level of concern that might cause them to be more willing to negotiate. But whether or not that's the case, it increases uncertainty. It makes it much harder for businesses to make decisions and to make investments and to know how to plan, and individuals to some degree as well. And then businesses also consider individuals to the extent that they sell products or services to individuals, because the individuals, if they slow down their purchasing, that slows down sales, and that combined with supply chain dynamics getting backed up can really slow the economy, essentially slows down buying and selling of products and services. So that nervousness is causing challenges in the market, which is in some ways a reflection of the outlook of the economy, while it is not the actual economy. There are a number of things to keep in mind when thinking about tariffs in this scenario. Is there the possibility that this could be a very skilled game of chess, or just a broad negotiation tactic that may not play out so well? That's too soon to be determined. The challenge of this type of environment as well is that when there is inflationary pressure from tariffs and the economy slows down due to tariffs, that increases the chance of what's called stagflation, where there's higher inflation and a stagnant economy. And the Federal Reserve, which has been working very carefully to control inflation and manage unemployment through interest rates, gets put in a real bind when there's stagflation, because the Fed's toolkit can really only work on one thing or the other, not both. So it can work on speeding up a stagnant economy or slowing down inflation, but if it picks one, it tends to magnify the other. So that makes it more challenging. The overall dynamics are challenging, are complicated, and that, again, that uncertainty is what is increasing uncertainty and market volatility. That market volatility has been reflected in the stock market in the last several months. The US market in particular was down about 5% in the first quarter of 2025. That was driven heavily by what are called the Magnificent Seven, some of the largest 7 stocks in the stock market, which had been on a very strong run for quite a number of years, and some would have said overvalued, and have cooled. The overall US stock market has been a little bit overvalued as well based on several measures. The good news is, and this is a bright spot for investors, that while the markets may be negative in other quarters, overall in the US, abroad, international stocks and emerging market stocks were positive during the first quarter, in many ways offsetting the US market. So investors who gave up on international who dramatically underweighted international out there in the investment world because of an impatience with those markets are now regretting that. Bond markets did relatively well in this environment in the US as a kind of a flight to quality, despite some of the concerns about international bondholders selling off some US government bonds out of concern about the US government and the dollar. And that is a whole nother topic for some of the long-term implications if the global investment arena loses faith in US government bonds or the dollar, then that complicates US policymaking and economic dynamics as well. The 4 worst major markets are shown here, with the global financial crisis is the dark one here. There's the depression, the dot-com bust, and the oil and financial crisis of the 70s. This chart is shown on an inflation-adjusted basis. So the global financial crisis had a stronger recovery and then experienced COVID and other dynamics and the interest rate hikes to try and rein in inflation, and then the recovery from those, and now some cooling due to the concerns about tariffs. But notice here that even if the very worst market, the Great Depression, took quite a while to recover, it took more than several years to get a full recovery after inflation on an inflation-adjusted basis. In this upper chart here, you can see it took fewer years. So on a relative basis, over the last 10 years, things are solid compared to some of those other markets. But one of the key messages from today that we'll talk about briefly later is that when there is a big drop in the market, it tends to bounce back very quickly and in unpredictable ways. So changing your asset allocation to something more conservative midstream, or going to cash, or getting out of the market is often what punishes people the most, because then you've locked in the loss and missed the recovery. So some of the best days happen very quickly and shortly after the biggest declines. So again, we'll cover that with some other charts in a moment, but that is a key message to remember to help you remain as a disciplined investor. Overall, US market valuations have been elevated compared to other countries. They've cooled a little bit with the current market pullback, but the international markets have been relatively attractively priced for a while, which is part of why they have seen more inflows and more of a market return boost in the last quarter. So overall, markets are still right now probably a little cooler here, but still a little bit elevated. So it wouldn't be surprising if markets cooled a little bit more before they had at least a little bit more before they had a recovery. So this is all part of a normal cycle. Valuations, returns are bumpy, and they're cyclical but not predictable in terms of the length or timing of cycles. There are a number of organizations that are predicting or estimating the chance of a recession. About a quarter ago, some were estimating the chance at being about 40 to 45%. Now with the increased talk and action around tariffs, one prediction is around 60%. So greater chance than not, some would say, that we'd go into some level of recession, although the depth and length of the recession would be to be determined. Now, if policy shifts in Washington, that probability could shrink quite a bit, but some of the damage has been done in terms of trust and uncertainty, and the markets may continue to wonder whether or not there will be big surprises on the horizon. This chart shows in gold here how the US stock market has been hovering at the top for quite a few years, but just before that it was hovering at the bottom for quite a few years as well. And this doesn't get into 2025, but now it's reversed again. And this is a good reminder how something can be out of favor for an extended period and then come back in favor and trade back and forth, but it's impossible to know how long. So this is a valuable chart to remind ourselves that just because something has a pattern, it doesn't mean that pattern will persist. In fact, it's almost a guarantee that it won't persist. It's just a matter of time. Some of the first quarter indexes, if we look at those Magnificent Seven that have been hot for a while, we're down 16%. The S&P broad US market, which is heavily influenced by and weighted by the Mag 7, down 4%. The large cap US value index up 1.6% or almost 2%. International about 7%, and bonds almost 3%. So overall, it's really been the US and some of the largest companies that have been the hottest, most overvalued companies that are taking the hit the most. And if you translate this into portfolios, if we take sample portfolios that we build for 401k plans, just as an example, which is approximately relevant for both personal wealth and endowment clients as well, in this last quarter, all portfolios were positive, regardless of stock bond mix. So despite some of the negative returns, having a diversified mix has been very, very helpful. The second quarter is not over yet, and we would be very surprised if there weren't some negative quarters across all portfolios, or at least most, at some point, even for diversified investors over the next several quarters or a couple of years, because we're in a less predictable time. But this is a great reminder of how diversification can be very powerful and helpful. Overall, if we look back 10 years, we can see that despite the current bumpiness in markets are still strong. Large cap growth, in which sit the Magnificent Seven, have really had the strongest return over the last 10 years. This number has already cooled quite a bit because of market returns, but other areas are catching up, which have been out of favor. So again, it's cyclical. Some things are out of favor and pull back. Some things are in favor and cool off. And but it's also a reminder that we are all, as investors, in this is a long run game. So looking at the 10-year numbers can be helpful, because short term doesn't matter as much if you're focused on a long enough time horizon. So if you were just to look at this chart, you wouldn't even know there was current volatility. Everything would look fine. 10 years from now, very likely to be able to say the same thing. This is a chart that shows economic policy uncertainty and the impact of politics, in other words, and just to show how policy can vary quite a bit. The more variable or unpredictable the policy is, the more that can impact markets, and that tends to be associated with more stressful times. Something like COVID was an external variable that was not controllable. Something like tariffs is entirely controllable. So some of it is, some would say self-imposed, and others would say exogenous or externally imposed. And those higher volatility times are also associated with more recessionary environments that may be partly causal and partly pure correlation. It's a good reminder as well to see and take a look at how often volatility occurs. 5% drops are common, usually about twice a year. 10% drops, usually about once every year and a half. 15% drops about every 3 years, and a drop of 20% or more is pretty common about every 6 years. So just a reminder how normal this is to have volatility, and you can see the recovery periods here. The bigger the drop, the longer the recovery, but in a scheme of a lifetime, a year and a quarter or so is not too long, and that means that you've had full recovery. Whereas if someone gets out of the market or reduces their risk profile inappropriately relative to their goals, then you're locking in the losses, whereas this is really talking about the full recovery period. That's one of the reasons we utilize capital market projections and economic forecasting to help design portfolios, and the range of returns is also projected. So we can see here a sample set of portfolios, prior year and current year, updates of asset allocation refinements, not at the stock bond level, but at the sub-allocation mix level, and the expected return and the range of returns. So these range of returns, we take, for example, 100% equity or 100% stock portfolio, it's fully within the range of expectations and normal to periodically see returns that are close to negative 20% in a year. There's only a 5% chance that it would be greater than about 18 or 20% in a negative in a year, and only a 1% chance that it would be worse than, say, negative 27%. Of course, the less stocks you have and the more bonds, the lower the projected return, but also the lower the downside and the lower upside. So the point here is that volatility and down markets are part of what's expected. It is normal. It is in the design of the portfolios, and the long-term returns. If you want to achieve the long-term returns, you need to be able to tolerate the volatility that may happen during the interim. It's also helpful to see that while sometimes down markets can be pretty steep, this is the Great Depression, the deepest, longest downturn, and there have been other steep downturns. It feels like it lasts a long time when you're in it, but if you look at this chart compared to the market rises, they are relatively small, relatively short-lived, and are less deep than the rises are high. So just having that context can be a very helpful reminder. Here, for example, a very brief drop and then a big rise. So if someone dropped here a lot from this point and then missed the recovery, they would have missed out on a lot. In fact, that goes for all of these cases. So don't miss the recovery. You have to be in it to win it. There are other interesting notes and data around what happens to the value of a portfolio if you miss out. So someone in this scenario for about a 20-year period that stayed fully invested would have had a 10% average return. This is a 100% stock portfolio, just as an example. If that same person missed just the 10 best days, that return over 20 years, missing only the 10 best days, would have dropped to 6.1%, missed the 30 best days, just 1.3%, and then returns are negative, missing 40, 50, and 60 days. So over 20 years, just missing the 40 to 60 worst days, best days rather, those are the big jump ups, the big recoveries that tend to happen shortly after there's been significant volatility, can not only damage your returns, but put you in negative territory when just staying the course would have led to a dramatically higher return. It's also helpful to know that while stocks get a lot more attention, bonds can be bumpy and have periodic drops, but in the long run, and so the dark numbers here are stocks and the orange numbers here are bonds, and you can see there have been some negative periods, including the period of higher interest rates that pushes prices down for bonds, but there's been some recovery since then, and bonds are currently providing a cushion against the stock market volatility. So just a reminder for those who have a life stage or a strategic plan or a overall strategy need that should not be 100% stocks, bonds are an important part of diversification. And while not exciting, more often than not will provide a significant amount of cushion against stock market volatility. Another way to look at patterns of markets, if we take the US market represented by the S&P 500, so the large cap US market, and run that line through the middle here, you can see more often than not in the last 15 years or so, other asset classes have underperformed. More recently, after this S&P 500 being on a relatively strong period, most other asset classes are outperforming, including international, emerging markets, bonds, and so forth. So it's just a reminder that what is hot then can be not, and markets take turns. It can also be helpful to see that but downturns take different shapes. Sometimes they are slower and more gradually lead to whatever their bottom is. And the recoveries tend to be shorter and steeper than the coolings. So that's takes an average of only 4 months for recovery from market corrections. This is a powerful image as well, showing the year by year what the highest point of the market was, what the lowest point of the market was, and where the market ended up in terms of return in the dot here. So you can see every year had negative returns, and some years had very high returns that were offset by some negative, but more often than not, despite even some pretty difficult years, a lot of market ended up positive. That is not a specific prediction for what we're going through now, but it's just a reminder that you cannot predict based on current conditions how the year will end up. More often than not, it pays off to stay disciplined in any given year, and then definitely in the long run. The alternative is not being invested, which loses against inflation and damages goals. It's also helpful to remember that there have been a lot of news events and political and economic crises that have affected markets over the years. And despite that, there are disruptions that cause the market to cool and cause people to be upset and to panic sometimes in markets. In the long run, there are recoveries, and it's always helpful to increase the chance of full recovery rather than missing out and going sideways and letting the recovery slip past you. It's also normal to see different economic cycles, whether it's early expansion, maturing expansion, late expansion, or recession. Right now, economists would say we're somewhere in this zone here between late expansion and recession. Impossible to predict when and to what degree that might happen, but things are cyclical, and then if there is a recession, that tends to lead to a recovery because of one or more combination of reasons and economic dynamics, and then starts again through early expansion. So it's a cycle that happens over and over, and again, just the timing and length and magnitude is what's unpredictable. It's also valuable to remember that there is a place for cash. There is a place for short-term investments, whether it's short-term bonds or cash equivalents, not as a long-term investment because that loses to inflation systematically over the long run, but for money that is to be spent in the relatively near term, it does make sense to have that money not in the market so that it's not subject to volatility. On that note, one way to think about that is their time horizon. So the most common portfolios might be long-term, and then a combination of short-term buckets, whether that's an individual or an endowment. And most people, for example, if they are in retirement building mode, might have most or everything in long term, but maybe keeping something in short term if you're working towards a down payment or are approaching, are very close to retirement, or are in retirement, have some money set aside so that your spending money, again, whether you're an individual or an endowment or any kind of entity, is available to you without being subject to market volatility. Another side benefit, believe it or not, there are side benefits to volatility. When markets cool, it gives you an opportunity to trim the asset classes that have been a cushion and to reinvest in those that have dropped. That helps buy more assets at lower prices, and when markets recover, that actually magnifies the value of your portfolio. So that's called rebalancing, and that can be is done a couple of different ways depending on the circumstances and the type of entity, but is a reminder that volatility has its opportunities, and we help clients take advantage of that by monitoring and rebalancing appropriately. And this chart over here shows that regular rebalancing versus just buying and holding actually reduces risk and increases return over time. There are a bunch of studies showing how individual investors harm themselves by being emotional investors, selling at the wrong time, hitting that panic button, letting the fear get the best of them, even if they're trying to do the right thing. But institutions are not immune from that either. Both have histories, studies show, of sometimes making the wrong decision about adjusting investments when there are concerns. And so both individuals and institutions would be wise to be aware of those psychological dynamics so that they don't end up detracting from your long-term goals. We would like to thank you for attending and listening, and please pass this on to anyone you think might be helpful. And we wish you the best, and we encourage you to be long-term investors and avoid emotional investing behavior for your long-term assets for your own benefit in the long run. Thank you very much.